In this video, I want to discuss the Bear Put Backspread. And I'm looking at this particular strategy, option strategy, right now because of my current sentiment, which is that I was 65% bullish, 35% bearish on the markets, and not neutral at all. And that's in the short term to midterm from now to 12 months from now. And long term, I am 100% bearish, so 12 months out. And this particular strategy is good because I am quickly becoming pessimistic about the market conditions as they are today. And I'm starting to move more towards a 50-50 bullish bearish mentality, and still not neutral. I think the markets are just crazy right now. They're going up and down and up and down, and more down than anything. So looking at this bear put backspread gives me an opportunity to be able to profit from the weakness in the market and its downward trend, if you will. Now, number of things are happening, though, as conditions worsen in the marketplace. As of this recording, the Fed had just raised the rate 0.75%, which is going to tighten things up a bit. Oil is still, north of $115 a barrel, and the 10-year Treasury that I pay attention to for economic and market conditions is on its way back down, but it went up to almost 3.5%, may have touched it, but right now it stands at 3.22%, and it's doing a lot of the tightening for the Fed, so they're just kind of adding fuel to the fire. But regardless, even in this downward trend, we can potentially look forward to a bear market rally. And I want to protect myself against that. And with my mentality being, again, that the market is going to not be neutral, I want to be able to profit from the downside portion, a little bit more bend to that particular way. Now, there's a number of ways I could play a downtrend, right? One is obviously, and I always mention this as far as any strategies, to hold cash, which I hold quite a bit of cash, looking for opportunities. I can do directional things, like a call credit, and if it stays below a certain price, then I benefit from selling that. I can short a particular stock, but then there's margin involved and a number of things like that. I could do a straddle, meaning if I'm 50-50, maybe a straddle would be a better play. But I don't know when the bear market rally, and if it's a bear market rally, then that means that my disposition should be towards the downside. And you could do a bull call backspread if your expectation is that there's maybe even a certain stock is going to be going up. I did a video on that, and I'll put the links at the end on the straddle. I also did a previous video on the straddle and the bull call backspread that you can watch. And again, I'll put the links at the end of the video. And but in this one, the strategy is going to be the bear put backspread. So let's just kind of take a look at the, as I used in the previous video on a bull call backspread, I'm going to use the Dow Jones Industrial ETF, DIA. It's currently trading about 300. It's after hours, but it's right at $300 a share. And but you could trade any stock. I tend to use ETFs, especially popular ones, just because there's open interest, which I'll talk about a little bit later, which makes it easier to buy and sell. And, currently, like I said, at $300, that's the price. So let's kind of take a look at the option chain and set this up. So I've used Thinkorswim. And in this option chain, as I did before, I'm going to look at July 15th as a date. And we'll look at let's see what this will bring us. We're going to sell an in-the-money put for somewhere between 615 and 1950. And we're going to buy two either at the money or out of the money. You can kind of adjust these, see what is favorable to what your thinking is. But you can see in here that for this particular scenario, I get an 87-cent credit. So if we do get a bear market rally, then I'll still benefit from this. I would basically receive $87. So that would at least cover my expenses. But I can make this as large or as small as I want. I could go further down, but it's going to widen my spread here on my break evens. And but if my expectation is that the price is going to go down, you can see I basically, I would normally say I have unlimited profit, but I don't have unlimited profit because at some point it's going to get to zero, or could get to zero, and then you can't go any further than zero. I do have a defined risk, which is good. One of the things I do like about this particular strategy, I could lose $300 on this, and if the market moves on these break evens anywhere from 285 we would have to move to by July 15th, or get above about $314 in order to get a profit. And you can see it's kind of a sliding scale here. So another thing I like about it is, unless it lands right at 300, I'm at least going to get something back. I'm not going to lose everything that I have. But so that's the story there. Now, the defined risk, I did misstate. $300 was the price for, if it stayed at 300 is my max loss, which is $1,405. So that's for the price of the three legs of this particular trade. Apologize for that. So that's in essence the setup. Now, the same scenario exists if I push out the date. So if I go to August 19th and I do a 315, I sell one and I buy two at 300. Oops, better. I'll delete these. And let's say I'm going to make sure I get the 315, 300. Buying. I'm going to sell one. Okay, I still have a credit there, so I might want to slide this one down till I get a credit. $295, 2. I may have to even go up on that. So I'd have to go 320, and even then I'm paying more for this particular setup, meaning also the premium helps determine my break even. So you can see now it's pretty broad. So in other words, it's going to move a lot. So it's going to move, if it's currently at 300, and my expectation is that it'll go down. But if I'm directionally challenged, which I've known to be, then I would have to move up to 316 if we got a bear market rally, and my break even on the other side is 273, and that's where I really would start to make money on it, is once it reaches 273 or below, and you can see the profit up in this area here, how far it winds up moving. The only thing I don't want it to do is stay right around here. Now, in a previous video, and you can go back and you can run this on optionprofitcalculator.com, and I did that with the bull call back spread, and you can go look at that particular video and see how I use the option profit calculator. That'll give you more of the nuances associated with movements between now and the time of expiration, which is a couple months from now. And so there are ways to profit from it if it moves fairly quickly, but maybe not all the way to the break-even point, while there's still some extrinsic value or value associated with time, and other factors that allow you to be able to get out of the trade. And I think I've said this before, I have a tendency to get out of a trade if it doesn't move the direction I thought it would. So, once I'm here and I'm getting pretty much my full profit, then I in the direction I didn't expect it to go, then I'll drop out of it. So that's the Bear Put Spread. Again, you can go to optionprofitcalculator.com, and you can run these numbers in it, and it'll break this down for you a little bit better. You can watch the video on bull call back spreads that I have, and I'll have linked at the end. So what else? Well, the other thing are the considerations that you have to have with this particular strategy. And the first consideration is the open interest. So the open interest for this particular Dow Jones Industrial ETF, I can just look on here. I can see that there's decent volume on what how many people are trading options in this. And why that's important to me is because if people are not trading it, then it may be hard to, first of all, get in or get out of. Now, the Dow Jones Industrial ETF doesn't necessarily reflect that there's a lot of open interest. You can almost tell with a $3 bid and ask difference. Maybe not my best option. I've traded it before, but things like SPY and other larger, Apple, for instance, typically has a lot of open interest in it. But you can determine that, and actually in my straddle video, there's a site that you can go to in there that identifies the top open interest underlines, whether they're ETFs or stocks or whatever they might be. So that's the first thing, is open interest. The second is volatility. Ideally, you would want things in a volatile environment. And the thing about, if the volatility is high, the premiums tend to be more expensive, and so you just kind of have to adjust for that and determine whether it's really worth the amount that you're paying for the spread. And you can see, even as I look at this, they're fairly even, but you just have to say, do I think it's going to move $16 this way and $27 this way in order to get the profit. If not, I can start to adjust where I buy and sell for each of the legs associated with the bear put spread. The other thing is, time decay. Again, I like to get in and out of these trades fairly quickly. Um, you know, if I'm usually out of them 4 weeks before expiration. Um, so that's one of the things that I consider. And then the fourth thing is the days to expiration, and that is that um, the number of days I give myself. I know people that will do things like be close to the reporting date if they're expecting a company to go down. Maybe a straddle would be a better strategy, but I've never found that to be a great strategy for me. Um, but if you're thinking it might go, you're leaning towards after they report their results for a quarter, if you're trading a individual stock, then some people will play either straddle or possibly or one of these strategies. And but I give myself time, at least 60 days, probably 90 is seems to be my sweet spot. It gives things a chance to move a bit. And like I said, once I start to see that there's something to pick up, then I start to consider taking it off for the normal reasons. Once you start making money on something, you want to take the profits. I've heard some people say that they'll take it off if they invested $1,400 in this and that's their max loss, then they might do 25%. Once it hits $350 in profit, they would take it off. Sometimes it just depends on how much time's left and a number of other things. And it's something you experience helps definitely, on this, but it's because it's defined risk, it's a little safer, and you can tell, from a max loss perspective that it's something that, $1,400 worst case scenario, but it can slide down on these towards the break-even points, and you wind up losing less. But that is the Bear Put Spread. And again, check out the videos that are up here on the straddle and the bull callback spread. I think they're really excellent tools for this particular time period. And I think it's just something to add to your arsenal and learn more about. There's a number of videos from other people, and I'm fans of most of the people on YouTube as far as teaching the basics. And there's a lot of different ways people use these different strategies. And it just kind of widens your arsenal of things when you're in uncertain times like we're in right now. And like I said, there's a number of other strategies you can do. You can sitting in cash is sometimes not all that bad either. So that is all for the Bear Put Backspread. And remember, there is always a better way.